Bharat Pimpli. Today we are discussing on ratio analysis. Now let's start current ratio. Current ratio. It is also called working capital ratio. This ratio is calculated between the current asset and current liabilities. The current asset, which asset convert into cash within the 1 year, it is called current asset. Current liabilities means those liabilities which are payable within the 1 year short term period, it is called current liabilities. The ideal ratio of current ratios is 2:1. The meaning of current ratio. The current ratio is also called working capital ratio. Working capital means current asset minus current liabilities. This ratio is calculated between the current asset and current liabilities. The working capital of an undertaking is an excess of its current assets over current liabilities. Therefore, as much is the value of working capital of an undertaking, its position shall also be sound so much. Formula of the current ratio: current asset divided by current liabilities. Then current asset is most important for any business and any firm. Next, liquid ratio. Liquid ratio is equal to liquid asset upon liquid liabilities. The ideal of liquid ratio is 1:1. Liquid ratio is also called quick ratio acid test ratio. It is calculated for a certain capacity of quick payment of undertaking. It is calculated between the liquid asset upon liquid liabilities. Liquid asset. How calculate the liquid asset? Liquid asset is equal to current assets minus stock. How to calculate the liquid asset? Liquid asset is equal to current asset minus stock. Liquid asset means those assets which be convertible quickly in cash as debtors, bills receivable, marketable security, cash, cash in hand and bank. It is called. Then we show liquid liabilities. Liquid liabilities, those liabilities which are payable, quickly payable, it is called liquid liabilities. Liquid liabilities is equal to current liabilities minus bank overdraft. It is called liquid liabilities. Formula of liquid ratio. Liquid ratios is equal to liquid asset upon liquid liabilities. This ideal ratio is 1:1. Then we show the stock turnover ratio. Stock turnover ratio means this ratio disclosure the relation between the cost of goods sourced and average stock inventory. It is called stock turnover ratio and also inventory turnover ratio. It is known by this that during the year how much time the stock was purchased. In fact, the profit of business have the deep relationship with the stock. If the stock is shorted in much quantity and the market price goes down, then it can be harmful. For uninterrupted daily sales to continue, it is essential that in sufficient quantity in the stock. Stock should be remain in the business, but it should not be so excessive that in it a portion capital intelligent and in case of full in profit in business. Formula of stock turnover ratio: cost of goods sold upon average stock. Cost of goods sold is equal to cost of goods sold is equal to sales minus gross profit. That is formula calculated of cost of goods sold. And average stock is equal to opening stock plus closing stock divided by 2. The formula of cost of goods sold is equal to sales minus gross profit. And how to calculate average stock? Average stock is equal to opening stock minus closing stock divided by 2. Now we explain debtors turnover ratio. It is also called as receivable turnover ratio. Every business undertaking purchase the goods for cash or credit. Those to whom goods are sold on credit are termed as debtors or book debts. In this way, also some purchase accept the hundi or bill receivable for the payment of the price of their purchase, which are called bill receivable. It is the effort of every undertaking to collect the debtors and bills receivable as soon as possible. Therefore, the debtors turnover is calculated to know the extent to which the undertaking is successfully in collecting the debt. Now we explain the formula of debtors turnover ratio. Debtors turnover ratio is equal to net credit sales divided by average receivable. For the calculating the average receivable, the total of opening balance and closing balance of debtors and receivable is divided by 2. In case the opening balance of opening debtors and bills receivable is not available, then the turnover is calculated on the basis of closing balance of debtors and bills receivable. In the same way, of the average of net credit sales is not available, then turnover can be calculated on the basis of total net sales. Now we explain the creditors turnover ratio. It is also called as payable turnover ratio. By any undertaking from the person to undertaking the credit purchase are made, those are called its creditors. In the same way, sometimes in exchange of credit purchase, the bills are also expected by the purchasing undertaking. These are called bills payable. This way, the creditors and bills payable are termed payable for purchasing undertaking. the following of creditors turnover ratio. Creditors turnover ratio is equal to net credit purchase divided by total average purchase. It is to be expressed the percentage term total average payable amount net credit purchase into 100. Thank you.